everyone. Welcome to this session on using the DFS standards to address the crisis of customer harm from digital finance. I'm thrilled and honored to be here today with you and among this group of distinguished speakers. We'll get right into it. I am Amelia Greenberg, Deputy Director of SPTF, which is a nonprofit organization whose mission is to make financial services more responsible and more inclusive. I'm joined by four panelists. Willie Blackman is Associate Director for Consumer Protection at Innovations for Poverty Action, which is a global research and policy nonprofit organization. Wayne Hennessy Barrett is Chair and Founder of 4G Capital, a financial service provider in Kenya. Alan Munoz is CEO of Banco Fiogar, a digital financial services provider in the Dominican Republic. And Sheila Senfuma is Head of Program for Digital Finance at Consumers International. We'll get right into it. My first questions are for Sheila and Willie. We are talking about a crisis of customer harm from digital finance. What are the biggest risks to customers from using digital financial services that you have observed? And also, can you quantify approximately what percent of digital financial services customers not only have faced these risks, but have actually experienced harm?
Thank you, Amelia. I'll go straight in. According to our research on the consumer experience on digital finance in 2022, 2021, and 2023, some of the key risks that we've seen have been mainly around frauds, and that goes around frauds on payments, frauds on digital credit, especially. But we've also seen varying degrees of these. Within our network, 74% of consumer associations from over 100 countries did bring out fraud as a top priority. But then globally, over 53% of all our members across high-income countries, middle-income countries, and then the low-income countries as well, still brought up fraud as the top risks that consumers were facing. And this was also coming across from traditional products in banking, coming across mobile money, digital lending apps, which are on the rise. But we've also seen a trend around AI, particularly deep fakes, where these are used to get consumers to disclose information or share their PINs or transfer money to fraudulent players. Other key risks that we've seen that came closely after fraud have been mainly around transparency, looking at issues around unclear pricing information, around complex and excessive information in contracts, and then unexplained and hidden fees. So all those were bracketed around transparency, still around payments, around digital credit, and around digital apps particularly. And then another one that has come out very strongly really has been around regulatory loopholes or regulatory gaps, especially in line with some of the new innovations that we are seeing in finance. And that goes still around issues like cryptocurrencies, around issues of digital lending apps where there is no particular authority that's usually mandated to set up consumer protection mechanisms around them, but also because it's something that has been new, so it's not falling in different existing frameworks around credit, around payments, around banking. So we've had a lot of feedback around that. In terms of the consumers that have actually experienced harm, I would say that these are over 1 million consumers, really, when you're looking at particularly Africa and Asia and Latin America, where we've tried to get more consumer-centered data. We're seeing over 10 million consumers who are getting affected or experiencing harm in terms of loss, financial loss, also in terms of when it comes to digital credit, in terms of reputational loss, when it comes to collection practices that are aggressive, where some of the consumers are blackmailed or people within their network are coerced to pay on behalf of consumers who have not paid credit that they took via illegal means or means that were not as clear when it came to transparency in the contracts. So these are some of the trends that we are seeing, and unfortunately they continue to exist or increase across various markets, informed by also instances where the data protection laws are not fully enforced. So that usually creates an enabling environment or an entry point for fraudsters to access consumer data and then use that to defraud them. I'll pause there for now for Willie to share his input as well.
Yes, thank you. And I think it's interesting and important to note what you said, that the harm is not only loss of funds, although there certainly is that harm, but also the things like the stress and the being victims of sort of aggressive behavior is another risk. Willie, over to you.
Excellent. Well, thanks so much, and thanks, Amelia, for the opportunity to be on this this important panel. And my responses are going to really echo what Sheila has just said, but coming from a slightly different angle. IPA over the past few years has run consumer surveys across a number of markets in Bangladesh, Uganda, Kenya, and Nigeria. And so what I'll share is a few sort of key statistics that we've found directly from consumers in these surveys, focused on 4 key areas that we found to be quite harmful: limited transparency, fraud, debt stress, and complaints redress. Of course, I'll just skim the surface here, but if you'd like to read more about what we have, I'll put in the chat right now a link to all of our reports. And just to highlight that we will have additional surveys coming out across 10 countries in the next year or so stay tuned for that. So starting off with transparency. Without accessible and easily comprehensible information on pricing and product information, consumers are going to be unable to make informed choices about the financial services that they use. So we asked consumers if they experienced unexpected or unclear charges, and we see a lot of variation across countries here. In Bangladesh, it's just 2% of consumers that report this as an issue, but in Kenya, it's 11%, in Uganda, 19%, and in Nigeria, 23% of consumers have experienced this unclear charge issue in the past year. Second is fraud. As digital financial services become more widespread, so too does fraud perpetrated on these digital channels, just as Sheila had mentioned. So we asked about exposure to fraud over the past 12 months and saw that this was very significant, again, with some cross-country variation. In Bangladesh, 29% of consumers have been exposed to fraud in the past 12 months. In Kenya, it's 56%, in Uganda, 33%, in Nigeria, 23%. Next is debt stress. Digital credit has the potential to be a very useful tool for consumers as they manage their finances, but quick and frictionless access to credit that's often accompanied by high fees and interest can lead consumers to borrow beyond their ability to repay. So one indicator of this is the types of sacrifices that consumers are making to repay their loans. We asked about this and found in Bangladesh, there's limited access to digital credit, so we didn't find a lot. But in Kenya, 52% of consumers had reduced food expenditures to repay loans. In Uganda, it's 32% reducing food expenditures, and Nigeria, 17%, which is quite concerning. We also looked at digital credit transactions in Kenya and used that data to identify consumers that had borrowed from multiple providers at the same time, and found that a minimum of 6% of digital credit consumers had 2 or more active loans at the same time period from different providers, indicating potential over-indebtedness. And finally, complaints redress. When consumers do have experience a challenge, they need to have an accessible way to lodge their complaints, and those complaints need to be addressed effectively. I'll focus on Uganda here, where only 39% of people with significant challenges lodged a formal complaint to try to resolve the issue. And there was a lot of gender variation here. We looked at all mobile money subscribers across the country, and we saw that 45% of subscribers were women. But then we looked at all of the complaints that were lodged to mobile money providers and saw that only 35% were women, meaning that women are much less likely to submit complaints than men. And this may actually make sense because consumers are not particularly likely to achieve a successful resolution when they do submit a complaint. Only 40% of those in our surveys said that their issue was resolved. I will pause there. Thank you.
All right, thank you. So this is very sobering, hearing about food consumption reduction, hearing just how widespread in every country these problems are. I'm going to turn now to our financial service provider representatives, starting with you, Alan. The array of risks is vast, but if you can focus on a few that Banco Filgar has worked to find solutions for. Please tell us what your experience is in the Dominican Republic in terms of some of the risks that your customers faced and solutions that you found to address those risks.
Good. Well, thank you. I will try to move on to a different type of financial service, now a digital financial service, and I'll move on to digital accounts. I know that digital lending can be one of the main products where risks can be easily seen, but within digital accounts, we've seen many risks to customers as well. Some of them that sometimes customers aren't even aware. During onboarding processes, we've seen the usual risks that you would assume you would encounter with account takeovers or identity theft. However, we've also seen, and it has been somehow, I would say, problematic for us. It's people being abused without their knowledge and having their identity taken over by either someone known or unknown, and they're unbeknownst to them being used to open fraudulent accounts. The accounts that they open are accounts for themselves. There isn't any identity fraud in the process. However, people are being used in order to open accounts that is then going to be used for fraudulent purposes. And we've actually seen it with older customers that have been used by family members to open accounts, and then those accounts can be used for fraudulent purpose, such as receiving fraudulent transfer and then wiring immediately the money to someone else. We've actually been a bit worried that we've seen it both from a perspective of people being used unbeknownst to them, and also people being used but being participants in the process. And those that participate in the process might not be completely aware of the legal risks that they face when they do this. And I think that education is part of the problem, but it's also part of the solution. And not only financial education, but education in general. Transparency has to be a key when you're thinking about helping people protect themselves. And then moving on to a separate risks, through our agent network, we have an extensive agent network. We also see many risks pertaining mostly to accurate information or misinformation from the agents. That could be because of poor training, or that could be, and probably one of the largest we face, is that they have a high rate of changes within their own personnel. So we go and train, and then you turn around and there's someone else taking care of your customers. And then we put a lot of effort into how we communicate, what we communicate, and how we let our customers know everything they need to know when they're carrying out either a loan or a payment. Then when they get to an agent network, you don't really have the full capacity of knowing how they're going to receive the services. And then information through all of the channels, making sure that people have the information they need, not necessarily from the agent, or they know where to get it, and they know that they have access to accurate information. I'll move it over to you.
All right, thank you so much. Yeah, those are good points, and I like how your solutions focus both on your interaction with the agent network themselves, but also your interaction with the customers. So you have a multi-pronged approach. Wayne, over to you. If you could pick a few of the risks that you see your customers facing and talk about the solutions that 4G has put in place.
Well, thank you very much, Amelia. I'll do my best. It's quite hard to follow these very, very profound comments. I guess I'll try to be generic and specific. We are a micro lender specifically to micro and small enterprises in Kenya and Uganda. So we provide these very small loans to the self-employed entrepreneurs who constitute 80% of Africa's GDP. So this is the future of the world. We know Africa is the future of the world. So this is the most important market segment because, by 2050, 1 in 4 human beings will be African and 1 in 3 working age adults will be African. So it's critical that we get these informal economies transitioning to formality and working well. Our clients are inherently quite vulnerable. They're low income, hugely resilient, incredible potential, but their skills and their education levels need work. And so they're inherently vulnerable to products which are not designed around them. And there's a lot of conventional mindsets which are really traditional credit businesses that are just trying to grow a loan book, increase the amount that's out there, and maximize the return. So I want to focus really on the customer protection, the DFS standards, the 6-7 standards that you champion and which we're very proud to try to emulate, are very, very important beginning. But designing products around the client, that's number one. What loan will help their business to grow? And so we do our best with that by blending enterprise training with each loan and designing those terms and conditions around the specific needs of the business. So client-centric product design blend with data and customer protection, particularly, we're a fintech, so we have to be very, very mindful of the customer's data and the cyber risks and the threats that Sheila mentioned. And then responsible pricing. So it's one thing to design that product so that it works, but it's also a really important and sometimes uphill battle to make sure that the price point works for the customer whilst reflecting the risk and explaining how that price point works all the way through the value chain. So it is high risk lending. These are unsecured loans to thin file, data light individuals. And so we have a great algorithm and we have incredible product and relationship officers in the field who supplement our fintech channels through a hybrid approach. But it's very, very important that, that we're able to secure mission-aligned capital, and that mission-aligned capital from impact investors, from DFIs, from local banks, all of whom we've been very successful in getting support from, understands the reality of the market, and that client-designed product is transparent, is fair, is understood by the customer. So the customer's inherent vulnerabilities of understanding what's going on has to be mitigated by really, really clear product delivery and explanation by us to them, and indeed by every practitioner to their customers, so that they know that what they get is what they get, without any hidden fees, without any nasty little sort of practices. And so we do see some pretty risky practices happening elsewhere in the market, where loans are collateralized. We see a loan officer take security on a loan from an asset that is way more valuable than the value of the loan. They'll give out $100 or a $200 loan and they'll secure it on a plot of land worth $1,000. That's not good practice. And so these are the kind of things that we all need to be aware of, because responsible pricing is really much more than APR. It's much more than effective interest rates. The loan has to be sustainable for the customer. It has to be sustainable for the business. It has to deliver yield for the investor, but it has to be delivered in a way that de-risks the whole credit value chain from end to end. And our firm belief is that the way to make that happen is through education, clear T's and C's, and really good product design, whether it's the customer's data protection, the terms of that product, or the way that it is utilized. I just give a strong recommendation to have real-time feedback loops. We're always doing surveys from our customers. It's a feature of the way the product is designed, so that their speech to us, their voice to us, is our greatest asset and our greatest way of being able to evolve in line with their needs. And we've been very blessed. We're a B corporation. We fly that flag very proudly. We're a proud member of your community, Amelia. And I really think the North Stars, if it's possible to have more than one North Star to try to sail by. I'll pause there.
That's great. And I think, a common theme that I heard from what all of you said is transparency. And Wayne, what you just mentioned about getting customer feedback, I think is also true in Bongo Fugar and really essential to transparency. So often we think it's just how have I delivered information to my customer, but part of that loop is listening to them back and making sure that they did understand and whether they did have any questions or challenges that were unexpected. So thank you for those good solutions. We're going to turn now to the DFS standards. And Abby, I'll ask you to call up my slides. The reason why this session was titled Using the DFS Standards to Help Mitigate This Crisis is that that's exactly what they're supposed to do. We spent about 2 years developing these standards. We did it with an international community of stakeholders committed to inclusive and responsible finance. So this work started with document review, with 50 approximately expert individual interviews to understand what good practice looks like and what others around the world have already learned. We took all of that good content and workshopped it in working groups for about 9 months, topic by topic, to say, okay, here's what we've learned about what good practice is for preventing over-indebtedness, for managing agents, for being transparent, topic by topic. From that working group process, we came up with a pilot evaluation tool, and it was in Excel. We pilot tested over the course of 8 months with 28 different institutions around the world, and then analyzed that information to say, okay, which of the practices have they already put in place? Which ones have they not put in place? And of those that they're not yet doing, do they agree that these practices in our DFS standards evaluation tool are relevant and feasible to them or not? So from all that analysis, we now have this great free tool that any organization can use. You see on your screen a link to download the tool, and it's organized by standard, but it covers a lot of topics. And for those of you who are familiar with our universal standards, those are management practices for responsible inclusive finance that we've been promoting for years. Back even before the advent of digital finance. And we took those concepts and adapted them to the digital world. And then we also added some new elements such as algorithm management that are new to digital. And so you can see on the screen the types of topics that this tool covers. The image on the bottom right is just a screenshot of the opening page. It's important to know that you can choose the language, English, French, or Spanish. And then Abby, if you can go to the next slide, I just give you an example on the next slide of the section on fraud. So what this shows you is that there's an essential practice that says the provider mitigates external fraud risk, meaning not employee fraud would be internal, but if we think about what a big problem external fraud is in the digital world, we say the provider has a responsibility to mitigate it and to assist customers who are victims of fraud. And then we have some indicators and some details, and the indicators and details are what are scored. So if you evaluate your own practices against the DFS standards, this is where you would score, yes, I'm doing this, no, I'm not, or I'm partially doing it, or it's not applicable to me. So you can see the first indicator, 3B61, says the provider assesses fraud risk by researching external fraud trends, analyzing customer feedback in order to identify the specific fraud risks in their market. And this has to be ongoing work because fraud strategies are evolving. But basically, this first one says it's the financial service provider's responsibility to be aware of the different sources of fraud in their market. And the second one says, okay, now that you're aware of it, you need to mitigate that fraud risk through at minimum the following activities. And then there's 3 details. One is investing in your own technologies and staff capacity. The second is analyzing data. It can be your transactions data. It should also include your complaints data to help you understand and identify suspicious activity. And then the education piece that Alan mentioned, informing customers using at minimum 2 different channels how to protect themselves. And finally, the 3B63 indicator is about, okay, if a customer was nonetheless a victim of fraud, what do you do? So there's some details about your responsibility as a provider to notify customers when you identify suspected fraudulent activity. And the window to do that depends on whether you're an analog or a digital provider, that you have the responsibility to investigate it. And then also, if the customer was not negligent, if they were victims of fraud and it was not their fault, then that the provider has a responsibility to restore lost funds. So I will pause there. That's just one example. I want to turn it back over to Alan. Banco Fulgar participated in the DFS Standards pilot, and I wonder if you can share with this group what that was like for you. Was it useful as a financial service provider to have an evaluation of your practice against these standards, and if so, in what way?
Yes, certainly. I think having the DFS standards is a very interesting way of formulating the steps to look into how you can better progress through being able to cover most of the bases, because it's a big cheat sheet. You have a very well thought out and very well prepared standards list that forces you to look deeply into your practices and see where you're actually doing good, but where you have places to go. And then after you're done evaluating yourself, then you're left with a checklist of what to do in order to move on with your plan. So we thought it was very useful as an analysis tool, but also very useful as a follow-up tool. I think it helped us better concentrate on what to move on with, and also to know which of the standards apply to us better than others. I think one of the challenges that we faced, and I know that's something that you looked into after the pilot was over, was that the auto evaluation was actually very comprehensive. And then it was, it's a challenge of having an evaluation that big fit in every category of every institution that takes it. And being able to sort through what better reflects your reality is a challenge, but it certainly helped us, and it gave us a framework to use as a planning tool to move forward after the evaluation was over.
You know what you said, I think is the core of the standards, which is it is supposed to be a tool, an internal tool. So this is not a document that you use to demonstrate your excellence externally. It's an internal training tool. And that what Alan said is exactly right. After you get this sort of comprehensive look, then you have a conversation internally about where are the gaps that matter to us, what are the ones that we need to address, and what are the ones that are less relevant. So very, very wise, Alan. We're going to close now with just a final remark from each of the other panelists. As you listen to the discussion today and you're thinking about not just the risks, but the solutions, what is one key takeaway that you'd like the audience to leave with? And Willie, I'll go to you to start first.
Excellent, thanks. So my takeaway, one thing that I would suggest you focus on is rigorously testing solutions to these challenges before scaling them up. I heard today Wayne and Alan talking about education, so I'll give an example related to anti-fraud education. We've tried this out in 3 different contexts, in Kenya, in Uganda, and in Nigeria. And 2 out of 3 of the times that we tried out these anti-fraud education campaigns through randomized controlled trials, we found that unfortunately they weren't that effective. They increased caution overall. Consumers were more likely to report anything as a scam, even legitimate messages. And then the 3rd time in Uganda, we made a small tweak. We changed the method through which the information was conveyed through integrated voice response and more interactive activity. And we found that in Uganda, this was super effective, and this education is actually improving consumers' ability to identify fraud. So the key takeaway is good ideas aren't enough. You got to test.
Thank you so much. And Sheila, over to you.
Yeah, just very quickly, I would say, in addition to everything, there is also a need to look at more vulnerable consumers. Just our recent research has shown that for every 1 point increase in vulnerability score, there is a 1.28 increase in the extent of negative outcomes reported by consumers. And that's within Africa, Asia, and certain parts of Europe as well. So I feel like even as we look at all the different frameworks and existing risks, we pay special attention to some groups of consumers that could be more targeted or be affected more in terms of the outcomes of the risks we are seeing. Back to you, Amelia.
Excellent point. Okay, that's sobering. Wayne, final closing advice for the world.
Well, I'm afraid I'm going to embarrass you, Amelia. It's a strong endorsement of the SPTF measurement and management matrices because they allow you to measure, they allow you to benchmark against all the various social performance vectors that are so important to all of us, and then to really set goals and measure progress. What we're doing is important. Financial services are either the greatest accelerant or the greatest risk to both the customer and the company alike. And so if you can really cleave to those things which embed your success with your customer's success and manage it and measure it, and you don't have to invent the wheel, you don't have to make it up as you go along. The hard thinking has already been done, and it's easily findable by just following your organization. So I'm afraid I make no apologies for that. It works, and it works well.
So a wonderful way to end, a call to action, and we appreciate the kind words and certainly agree with what you just said, that digital finance has that balance of could do the greatest harm and also the greatest good. So let's do it right. Thank you so much, everyone, for your participation, and enjoy the rest of Financial Inclusion Week.